Why do some traders consistently profit while others struggle? The answer isn't luck, it's market structure. Trade without it, and you're navigating a maze blindfolded, risking dead ends at every turn. Stick with me, and by the end of this video, you'll see the market's roadmap. Crystal clear, no complex terms. Before we dive in, do us a favor. Smash that like button, subscribe, and hit the bell so you never miss these game-changing insights. Let's begin. Imagine trying to drive without a GPS. That's exactly what trading feels like when you ignore market structure. Every move in the market can be broken down into three simple phases: uptrends, downtrends, and consolidation. These phases repeat in a cycle, and spotting them early is your ticket to staying on the right side of every trade. Too many traders lose money by jumping in without understanding which phase the market is in. Today, I'm going to show you how to avoid that pitfall. We'll start with the basics, then move into some advanced techniques that professionals use, like spotting fakeouts versus genuine breakouts. Let's simplify things. In an uptrend, prices are making higher highs and higher lows, much like climbing a staircase. In a downtrend, the opposite happens: lower lows and lower highs, similar to descending an escalator. But rarely do markets move in a straight line. They often pause in consolidation zones where prices move sideways. These pauses are crucial, as are the times when big players like banks and institutions place their orders. Here's a pro tip. Before you make any trade, ask yourself, is the market trending up, down, or is it consolidating? If you're not sure, it's best to wait. Patience always beats impulsiveness. In a perfect world, uptrends would be smooth and textbook-like, with clean, unbroken waves. But reality is messy. Prices often surge, pull back, consolidate, and then push higher. The key is to focus on the major highs and lows. These act as guardrails for the trend. For instance, if the price breaks below a major low in an uptrend, that's a red flag signaling a potential reversal. But if it holds and then breaks above a major high, the uptrend is likely to continue. Now let's talk about the break of structure, or BOS, a real game changer. A valid breakout occurs when the price closes decisively above a major high in an uptrend or below a major low in a downtrend. Here's where many traders get tricked. A genuine breakout will close with a strong candle body, not just a fleeting wick. A fakeout might show a quick spike with a wick that soon snaps back. Trust only when you see the strong, decisive close. Next up is the change of character, or CHOCH, which signals a potential trend reversal. But be careful, not every CHOCH is significant. A minor CHOCH might just be a temporary pullback, whereas a major CHOCH, where the price closes beyond the last major swing low or high, is a high probability reversal signal. A common mistake is short selling after a minor CHOCH, only to get stopped out when the trend resumes. Always wait for that major confirmation. Let's put it all together. First, identify whether the market is trending up, down, or moving sideways. Then, mark the major highs and lows as your guideposts. Trade breakouts only when the price decisively moves beyond these key levels, and confirm any reversals with a major CHOCH. If you found this breakdown helpful, drop a BOS in the comments to show you're ready to trade smarter. And don't forget to like, subscribe, and ring the bell. Each week we break down complex strategies into simple wins. Let me know what topic you'd like to explore next. Until then, trade safe, and I'll see you in the markets.